Hello, everyone, and welcome to today's webinar, Management Services Organizations, MSOs, more relevant now than ever before. My name is DiGuglielmo, and I'll be the moderator today. Today, our presenters are Frier Levitt's co-founding partner, Daniel Frier, and Senior Counsel Theresa DiGuglielmo. If you have any questions, you may submit them below, and we will do our best to get to them at the end of the webinar or after the webinar via email. With that, let's get started with Daniel.
Thanks, Katie. Welcome, everybody. I'm excited about today's webinar because this topic is a topic that has come up, I think, more frequently in the last 2 years or 3 years than probably the previous 10 years. And we are just inundated with requests to form MSOs in various capacities. So aside from having you read this disclaimer, which I won't do, the only thing I'll mention today is that today we're doing a webinar. We are not dispensing legal advice, and we do not, for purposes of today's webinar at least, have an attorney-client relationship with respect to what we're talking about today, even though some of you on this webinar may be our clients, and thank you for that. So today's webinar, we're going to talk about 5 areas. Teresa's going to talk about what an MSO is and how it might benefit healthcare practices, why private equity seems to be interested and utilizes the MSO model. Second issue is we're going to discuss the broad regulatory issues that affect MSOs and need to be considered in forming an MSO. We're going to, number 3, talk about how to structure an MSO to avoid regulatory pitfalls, as well as just to meet the business needs and desires of the participants. Number 4, we're going to discuss how to establish an appropriate management fee. And finally, we'll talk about some practical examples of MSO structures. Teresa, why don't you explain what an MSO is?
Sure, Dan. An MSO is an entity that provides administrative support services to a medical practice. This can encompass a variety of services ranging from billing and collection, provision of VHR, credentialing, supervision of non-clinical staff, HR functions. The MSO may also lease space and equipment to the practice and might also engage in some functions such as group purchasing, acquiring malpractice discounts, and generally achieving economies of scale that aren't really available to solo, small, or even medium-sized practices. There are many types of MSOs. Some provide a few services, others provide a broad array of services, such that it is essentially a turnkey experience for the medical practice. All of this can alleviate the administrative burdens of operating the medical practice and allow the clinicians to focus on patient care. I would describe the major motivations for the practice as efficiency and cost savings, which is really attractive to practices facing financial challenges in these difficult times. And I'd also like to mention that an MSO provides a vehicle for business ventures between licensed physicians and non-physicians. And we'll talk later about the corporate practice of medicine prohibition and how that pertains to the MSO model. Next slide.
Yeah, I'll talk briefly about the private equity perspective. Many of you on this call may have direct or indirect experience with the private equity model of acquiring the assets of medical practices. Generally speaking, and I can't think of really any exceptions, in any state that has a corporate practice of medicine prohibition, which Teresa will talk about shortly, the MSO is used by the private equity for its ownership. And what I've counseled clients on over the last couple of years is, if you are considering a private equity transaction, forming an MSO in advance can have a variety of benefits. The reason the MSO is utilized is that, as Teresa will explain, from a regulatory perspective, private equity entities are for-profit entities that are owned by non-physicians typically, and they cannot own medical practice directly. So that's one of the reasons you've seen a proliferation of MSOs. Teresa, you can address some of the regulatory issues.
Thank you, Dan. A significant consideration in structuring compliant MSOs is the corporate practice of medicine doctrine. This is rooted in the principle that the practice of medicine must be the exclusive domain of licensed physicians, and there can't be any interference by outside influences on that licensee's clinical judgment. One of the underpinnings of the doctrine is that, licensees are regulated, they're bound by ethical rules in a way that makes them very accountable, and the influence of non-licensees can corrupt their medical judgment. Profit motives may lead to overutilization and can adversely affect patient care. Next slide. The application of the corporate practice doctrine really varies among the states. So in order to evaluate an individual state's stance, we'd have to look at statutes, regulations, court decisions, attorney general opinions, licensing board actions, or all of the above. There are strong corporate practice of medicine states and weak corporate practice of medicine states, as described here. But generally speaking, even in states that do not strictly enforce the corporate practice of medicine prohibition, the notion of non-interference with a physician's clinical judgment is evergreen. Next slide. The implications of violating the corporate practice prohibition include potential discipline for the unauthorized practice of medicine, fee splitting, self-referral, and there is also a potential for challenges from payers. So I'd really like to briefly summarize some of the important takeaways from these precedential cases mentioned here. And I'll do so as succinctly as possible. The 2005 New York case of State Farm v. Malala is very well known for finding that when there's a non-physician ownership of a medical corporation, it may be deemed a fraudulently incorporated enterprise. Now, this concept of fraud in the corporate form is really important because it provides another avenue for a payer to deny or recover payments, and it has absolutely nothing to do with the legitimacy of the medical claim submitted by the practice. This is something that people underestimate when they consider the corporate practice of medicine prohibition. And this precedential case law makes it clear that an improperly structured professional practice can form the basis of a challenge by a payer. Moving on to the 2015 Aspen Dental matter. This was an attorney general action where an MSO was found to have infringed on the clinical purview of licensed dentists, and it occurred in multiple ways. Two examples I'll offer were the MSO had developed clinical protocols that really should have been the domain of the dentists, and the MSO also applied pressure on the dentists and the hygienists to increase the sales of services. I think there's a lot of really good guidance for New York MSOs in particular in the Aspen Dental case, but I'm going to limit my comments to three important points. One, we most often speak of the corporate practice of medicine, but the corporate practice of dentistry is also an issue. Point number two, this case illustrates a different kind of outcome than the payer withhold I described in the Malala case. In Aspen Dental, the AG imposed a corrective action plan with very strict parameters. The group is continuing to be monitored by the AG's office, and there was a civil penalty assessed of $450,000. Another issue that arose in the Aspen Dental case, and it's an issue for which this case is off-cited, was the manner in which the MSO held itself out to the public. One of the findings by the AG was that the MSO's marketing materials referred to Aspen Dental, the MSO, in a way that implied that the MSO was the provider of the dental treatment. So an important takeaway for other MSOs is that it's really important to distinguish in advertising to the public between the management entity and the separately owned licensed dental or medical practice, as it were. In the interest of time, I won't say much about the 2019 Carruthers case, except to comment that it echoed the Malala case in that there were non-physicians found to have been de facto owners of a medical practice. So it's another example of this so-called fraud in the corporate form, a situation where the physician is really only a nominal owner who doesn't engage in the practice of medicine through the entity or otherwise exercise any control over the practice. This is very problematic. And finally, I want to mention the 2017 case of Allstate v. Northfield. This case is notable because it involved a structure that was promoted by a California-based chiropractor and a New York-based healthcare attorney in a lecture series they called Practice Perfect. So there was a New Jersey licensed chiropractor who attended the lecture series. And of note, the corporate practice of medicine prohibition that I've discussed here was mentioned at this seminar, and it was acknowledged to be an important issue. But the workaround that was suggested was extremely problematic. They established a nominal only ownership of the medical practice by a physician who didn't treat patients and had no operational control of the practice. This allowed the chiropractor owner of the MSO to maintain control of the medical practice. Now, there are a couple of important points here. One is, a chiropractor is a licensed healthcare professional, but this kind of arrangement isn't permissible in New Jersey because a physician cannot be employed by a licensee with a more limited scope of practice. And the court in the Allstate case found two very notable features in the written agreements between the parties. One was the ability of the MSO to remove the physician owner and transfer the physician's interest to another physician of the chiropractor's choosing. And the other was a very severe monetary penalty of $100,000 that would be charged to the medical practice for breaking the lease. So the court looked at this and said, it's so obvious that you're trying to prevent the physician owner from actually controlling the medical practice. And the court used really strong language here. They called it a sham designed to circumvent the law and create the appearance of compliance. I have emphasized this language because it's a very important takeaway. Deliberately creating a form over substance, patina of compliance, will not support a defense, particularly against these claims by carriers of insurance fraud. They will look to the underlying structure and the operational realities to determine whether the law has been violated. And I want to be very clear here, the recovery of money by the payer in that case had nothing to do with the legitimacy of the medical claim. The patient received medically appropriate treatment, furnished within the standard of care. It was documented, it was coded and billed properly, except that the underlying practice structure was deemed invalid, and it rendered otherwise legitimate claims invalid as well. So all of the facts and findings in these cases are just reminders to us that we have to approach this MSO structure very carefully. We cannot just be compliant on paper. MSOs must also be operationally compliant to withstand the scrutiny. Next slide.
So fee splitting. Fee splitting is a term that is often used, and it typically references state law prohibitions that have their roots in corporate practice of medicine restrictions. There are people on this call from multiple states, so we're not focusing on a particular state. But fee splitting essentially is the splitting of fees between providers, professional providers, licensees, and non-licensees. This can arise when physicians enter into a contract with an MSO, and there's a percentage arrangement where the percentage fee exceeds fair market value, such that the amount that's being charged by the MSO is more than just for the services the MSO is charging, but rather is really a mechanism for the MSO to be a profit sharer, share in the profits of a medical practice. Paying an MSO for legitimate services is generally appropriate and common. Paying an MSO as if it were a partner in a medical practice is not. And we could probably do an hour-long lecture just on the various state fee splitting laws, but it's beyond the scope of today's webinar. But I think it ought to be something that you understand is an important consideration when you're putting together an MSO relationship. So the federal self-referral law, otherwise known as the Stark law, is a law that is often implicated in these types of MSO arrangements. the law basically says, and I'm not going to get into a long discussion of it because I'm sure many of you have some familiarity with it, but it prohibits physicians from referring certain types of services, typically or specifically DHS, designated health services, to an entity in which the physician has a financial relationship. So if a physician is referring patients to a lab that the physician owns, or an imaging center, or for physical therapy services that the physician has an ownership interest in, then the Stark law is implicated. But on this slide, you can see a list of the full list of the categories of DHS. What often happens with us is we were asked to analyze a situation and determine whether a particular DHS is implicated or Stark is implicated. And we look at these categories, but what we really need are the CPT codes, because CMS publishes every year a list of those CPT codes that constitute DHS, and they're very, very extensive. In radiology alone, there could be 50 or 100 different codes or more that relate to DHS. And there are certain radiology services, for example, that although they're radiology services, don't constitute DHS. So you really have to look at the CPT code list that CMS publishes each year to determine. There are exceptions to Stark's prohibition on self-referral that relate to the kinds of services that a management services organization provides. And in the next slide, I'm going to explain a specific example of how Stark could be implicated in an MSO arrangement. But keep in mind that the most commonly violated part of the exception that's applicable to MSOs is what I have here underlined as number 5, where the aggregate compensation paid to the agent, in this case the MSO, over the term of the agreement is set in advance, is consistent with fair market value in an arm's length transaction, and is not determined in a manner that takes into account the volume or value of referrals. Those 3 components that comprise this number 5 are often the most challenging ones. Now, in many MSO situations, the Stark law is not implicated. In a typical transaction where the MSO charges a fee to the practice, and the practice is not performing DHS, not performing lab services, not performing imaging services, Stark is not implicated. But here's an example of where Stark may be implicated. You have on the right side a medical practice that's owned by physicians and also owns its own laboratory. And the physicians who own the medical practice refer to that laboratory. There is an exception under Stark that's called the in-office ancillary services exception that allows the referral of DHS within a single group practice, as long as that group practice meets certain requirements. So let's assume for the moment that the medical practice at issue meets those requirements, meets the definition of a group practice, and therefore complies with Stark, even though it's referring and the physicians are profiting from the lab services. Now introduce the concept of the MSO on the left. One or more of the physician owners of the medical practice also own the MSO. And the MSO charges a percentage fee, like is often the case, for example, in a private equity transaction. MSO charges, let's say, a 10% fee. Now what happens is the physicians who, before the MSO became involved, received a portion of the lab revenue, the DHS revenue, from their ownership in the medical practice, and complied with the group practice definition. There are various, it's somewhat complex how those lab revenues could be distributed, but assuming that they complied with that, now you have a situation where a portion of those lab proceeds, those lab revenues, are being paid over the MSO because the MSO is charging a percentage of total revenue. Now the physicians who are referral sources are getting a percentage of the MSO's revenues, which include the lab revenues, and that can implicate Stark. And that's where an analysis has to be done and a determination made whether or not those Stark revenues, those DHS revenues, have to be carved out of the MSO fee, or whether the MSO fee is an appropriate MSO fee. Teresa, why don't you talk a little bit about the Anti-Kickback Statute?
Sure. So I won't read the text of the Anti-Kickback Statute that we've quoted here. probably many of you are familiar with the concept and the prohibited remuneration that is at the heart of the Anti-Kickback Statute. I'll mention that the statute has been interpreted broadly by the courts to cover any arrangement where one purpose is to induce referrals or reward referrals. So one context in which this concern arises with respect to MSOs is when the physician owners of the MSO are in a position to influence referrals, and their distributions of the MSO's profits are larger as a result of the referrals. So the management fee paid to the MSO implicates the Anti-Kickback Statute and needs to be analyzed, as Dan described, with respect to Stark. Next slide. The good news is that the elements Dan described for satisfying Stark are applicable in the context of the Anti-Kickback Statute and reduce the risk of violating it. So all of those elements, particularly the ones highlighted by Dan, will be very protective of the arrangement. Next slide. Just want to make a brief comment regarding marketing and advertising services. There are a variety of marketing services that an MSO might provide, and there are some basic ones that generally don't raise concerns under the Anti-Kickback Statute, and I'd like to give a couple of examples. The MSO might monitor the practice's Google AdWords campaign or generate some data analytics reporting and metrics to measure the success of a search engine optimization effort or some such thing. And those aren't the kinds of marketing or advertising activities that really worry us. The Anti-Kickback Statute is implicated when a direct marketing arrangement occurs, where there is outreach directly to physicians who are in a position to refer to the practice. This can happen whether it's in person or sometimes via a referral website where practices pay to join and they participate in such a way that they're paying a percentage of the referrals generated by the advertisement. So when more aggressive direct marketing techniques are involved, we would recommend the parties consider addressing those services through a separate agreement and not through the management services arrangement.
And I'll just add to that, Teresa, that in any instance where you have a marketing team, whether it's part of an MSO or part of a standalone marketing company that is directly soliciting from physicians, the reason it implicates potential anti-kickback issues is that the very act of soliciting a physician can, depending on how intensive it is, actually constitute a referral, making it so that the marketing company is actually deemed to have made a referral to its customers, even though it's not a provider. Because the definition of referral under the Anti-Kickback Statute is so broad that it actually includes the arranging for services. We have been involved on a national basis with many sales companies, sales forces that have been investigated both civilly and criminally for engaging in that type of intensive marketing and then receiving a payment from their customer that the government felt constituted remuneration in exchange for referrals or a kickback. So this is a big slide, and it's worthy of a few significant comments. Structuring the MSO arrangement. So we spent a lot of time putting together MSOs. I mean, for me, the first question when a client says we'd like to do put together an MSO is, well, why do you want to put together an MSO? I think it's my job, it's our job as attorneys to ask that question before we go ahead and just create something for a client that may or may not be useful. And the question becomes, why is the client interested in putting together an MSO? And there could be a variety of reasons. We've talked about a few of them. It could be that you want to pull out the assets from the practice, put it into a separate MSO so that MSO can be owned potentially by non-physicians. It could be owned by outside investors. It could be owned by non-licensees who are part of the practice but can't own the practice. It could be used to limit the amount of liability or improve asset protection methods. so that now the practice has fewer assets that are exposed in the event of a malpractice case. It could be used because the parties want to form an MSO so that they can provide MSO services to other practices that are not related to the practice at issue, if they have particularly good systems in place. It could be used because the group wants to consider private equity and they feel that having an MSO will improve the optics of the platform as a whole. In forming an MSO, I will say that the vast majority of MSOs that we form are formed as limited liability companies, as opposed to any other form. First of all, you certainly want the MSO to be limited liability, so it has to be either an LLC or typically a corporation. LLCs tend to be more flexible than corporations because they can always be converted without usually any major tax implication to a corporation at some point if they need to be. And because LLCs are very flexible in terms of how profits can be distributed. And an example of why flexibility is important is if you have a medical practice that forms an MSO that's owned by the same physicians that own the medical practice, there may be reasons in the MSO to distribute profits of the MSO differently than just per capita. And without getting into too much complexity, if you have an MSO that consists of a large practice that services a large practice with various divisions in it, but the MSO charges, kind of a fixed amount or a percentage amount, then if the practice, physicians and divisions are all earning different amounts of money, but the MSO is charging a flat percent or a flat amount, and the MSO profits are distributed per capita, then you're sort of redistributing some of the revenues from the practice in a way that may not be palatable. So a doctor that would otherwise only get 12% of the revenue is now getting 15% or 20% because their ownership interest in the MSO. So you can restructure the profit distributions in an LLC very flexibly, whereas with a corporation, profits have to be distributed based upon ownership. We also often will form MSOs in Delaware rather than forming them in the state where they might reside. And the reason for that is very simply that Delaware is looked at by corporate America as a safe haven for businesses. The laws of Delaware are favorable with respect to entities, and it's a familiar place so that if you're looking ultimately for future investment, you're likely to appeal to those investors. The determining the ownership composition of the MSO is very important. In some instances, depending on what the MSO is doing, how it's charging, having physician owners can be a good idea. It can also be a bad idea depending on, if those physicians are employed physicians. In some cases, people want employees to be owners of something, but don't necessarily want them to own the practice. But in some cases, if you have a physician owner of an MSO, you implicate Stark, as I mentioned before, because now the physician is earning money off of designated health services, not only as a physician, as part of a group practice, but also as part of an MSO, and it's harder to meet the Stark exceptions to that. Another step in structuring the MSO is you typically have, in terms of documents, you have you form the MSO, and that MSO would have an operating agreement that governs the ownership interests in the MSO. And then the MSO would have a management services agreement or administrative services agreement, as it's sometimes called, with the practice. And that MSA, or management service agreement, would list the various services that will be provided. Those services should be enumerated. I typically put them in an exhibit so that they can be changed over time without having to change the body of the agreement. There are, if the MSO is going to be providing billing and collection services, there are certain states that require that you register with the State Department of Banking and Insurance as a billing company, and so you need to do that. Some states will not require you to do that if the owners of the MSO and the practice are the same, and you only have one customer, namely the practice. But if you extend beyond that, or if the ownership changes so that the MSO is owned by different folks than the practice, then you're going to need to look into those laws. Calculating the management fee is one of the most complicated parts of putting this relationship together. And there's a couple of different methodologies for doing it. as I referenced before, most private equity transactions charge a percentage. And in some states, you cannot do that. You cannot charge a percentage. In some states, you can, and in some states, it's a little bit gray. So for example, in New York, you generally cannot charge a percentage fee. Even a billing company cannot charge a percentage fee in New York. Other states, you can charge a percentage fee. And some states, I mentioned, it's not entirely clear whether you can do it, but the private equity model generally favors very strongly a percentage fee, and the MSO gets its fee, and then the practice gets the balance of whatever's collected and distributes it to the physicians. Aside from a percentage fee, the problem with the percentage fee can be, you can get into fee splitting problems. You can also get into Stark problems I mentioned before. So a very common approach is what's called a cost plus approach. Under a cost plus model, the management company typically takes on a turnkey role, meaning it rents the space that the office of the practice. It employs all the non-clinical staff. You cannot employ the clinical staff in most states because that's the practice of medicine, but it can employ all the non-clinical staff. It buys all the supplies and equipment. It takes on the risk of the equipment. For example, if you have an equipment lease, it would take on that risk. It would arrange for the purchase of malpractice insurance. It would provide operational services to the practice. It would provide administrative support to the practice. The cost of all that, which is borne by the MSO in a cost plus model, would be charged back to the practice. So that gets the MSO to break even. And then there's a plus component, which is cost plus a percentage of those costs. We typically see that in the range of, let's say, 10 to 20%, give or take, so that the management fee would be the cost of the services plus a percentage of the cost of the services, which altogether avoids charging a percentage of the collections in order to avoid a fee splitting issue altogether. One of the, and I've also seen a flat fee approach. So one of the challenges to of setting a management fee in a way that's not percentage based, rather as cost plus or flat fee, is that in some models where the goal is what we'll call a captive practice model, and I'll get into that a little bit later, where essentially the goal is for the MSO to exert as much control over the practice as is legally permitted. The goal is to sweep as much of the profits out of the practice as can legally be done. And this can be fraught with some danger. It's often done in a very cavalier way where basically the practice owned by the physician gets a set salary and then everything else gets pulled out into the MSO. In most states, that's not appropriate to word it that way. The end result may be that that's the case, depending on how much the revenues of the practice are. So one of the challenges of a cost plus approach or a flat fee approach is if the practice generates more money than it needs to pay the physician an agreed upon amount and then pay the MSO, the remainder, I'm asked this question, well, what happens to the remainder? And my answer is, well, it goes to the owner of the practice, who is the physician. And that's just the way it is. It may be avoidable, it may be non-avoidable. It often doesn't matter, in the private equity setting, with a percentage arrangement, it's a non-issue. The more money that's generated, everybody, including the private equity owned MSO and the practices, they make out well. But in a cost plus approach where there's a ceiling as to how much the MSO can charge, the balance could go to the physicians. There's a variety of ways of dealing with that, but the first thing we do is make sure that whatever we're doing is legally compliant. Because as Theresa said, if it's not, the consequences are pretty severe, as she demonstrated in some of those cases. In calculating a management fee, we also often recommend that a formal valuation be done to ensure that the fee is consistent with fair market value and is commercially reasonable. So commercially reasonable, it's worth mentioning, is the redheaded stepchild of Stark and anti-kickback. It's often overlooked, and it's more popular twin. The fair market value concept is often given all of the attention. But I'm going to give you an example of what commercially reasonable means. If the management company is trying to get the management fee as high as possible, and it's charging, let's say, for rental of a space that is much more than the practice needs. So envision an MSO that's owned by primary care doctors, and it's managing a specialty practice that the primary care doctors refer to regularly. So the specialists own the practice. They pay a management fee to the MSO, which is owned by their referring doctors. The specialists are happy to pay as much as they can legally because they're getting referrals. But if part of that management fee is to cover the cost of space or equipment or other things that are beyond what the specialist practice needs, then even if fair market value for that amount of service or space is paid, it may not be deemed to be a commercially reasonable transaction because the amount of space, the amount of service is more than what is needed by that specialty group. So we often get a formal valuation to kind of by a third party to do that assessment. And we use, in terms of doing valuations, we use two different categories of valuation firms. There are large national companies that are more expensive. They're more a little bit more, I'm not even going to say more comprehensive, but they're better known in the industry. And then there are smaller valuation companies, often associated with accounting firms, that can be very, very good at doing those valuations, a little bit more cost effective. And depending on the magnitude of the transaction, we might recommend one or the other. Law firms do not do valuations. I'm going to skip over to the next one. Let's talk about just examples of MSO structures. We'll talk about three: the PE model we talked about a little bit, the friendly PC model, and the deceased physician model. I've already talked a little bit about PE, but I'll just mention that the PE model typically is to go into a region, find a practice that it can utilize as a platform. Remember, PE, generally doesn't have the expertise to build a practice from scratch. So they want to find a practice they can utilize as their platform. And they will go in there, they'll enter into a management service agreement, usually charge a percentage, and that percentage will pull out a certain amount of income from the practices into the MSO. And whatever the profitability of the MSO is, that becomes the earnings of the MSO that are, upon which the purchase price is based. The friendly PC model, which I mentioned before, is often used in conjunction with the deceased physician model. What do I mean by that? So we've had a number of clients over the years where let's say the physician is either the solo physician or the physician in partnership with another physician has died, and the family or the estate of that physician wants to continue to operate the medical practice and profit off the medical practice in a legal way. They cannot own the medical practice, the family, unless they are all physicians, which in most cases they're not. So we may form an MSO which manages the practice and manage it through this friendly PC model. The friendly PC model, which I'm going to explain in a second, can also be used in other contexts. It's often used by private equity. They buy a practice, they install a single physician owner, and the other physicians become employees. It's used by hospitals. In most hospital transactions throughout, depending on the state, but certainly most that I've seen, the hospital doesn't actually own the medical practice itself. But the hospital is affiliated with a medical practice that is technically owned by the hospital's VP of Medical Affairs, who is the technical owner of the practice, and the practice that employs all the physicians that are the subject of a purchase agreement, et cetera. The friendly PC model, the essence of it is that the MSO provides turnkey services, essentially runs the non-clinical aspects of the practice, and installs a physician owner who is the technical owner of the practice. I'm just going to caution everyone about the friendly PC model. It can work very, very well if it's done properly, but it's more frequently done improperly than properly in my experience. I will say that again in another way. Most friendly PC model transactions, in my opinion, are done improperly. They don't recognize that in order for physicians to have adequate control over the practice of medicine to avoid a corporate practice of medicine violation, the physicians can't just have control over seeing a patient in an office one day. In my opinion, physicians have to have some level of control over what services are being provided, what equipment is being leased or purchased to provide services, what the contracts with managed care companies look like, and what is expected of the physicians that perform services through those contracts, what contracts with hospitals look like, things like that. There's more than just the actual treatment of a patient in the office or in the hospital that is necessary in order to afford physicians enough control over practice that we don't avoid corporate practice of medicine issues. I'll let Theresa talk about some of the takeaway points, and then maybe we can answer any questions if there are any.
Thanks, Dan. So takeaway number one is really that MSOs alleviate the administrative burdens on a medical practice. They can achieve economies of scale and be very useful to physicians who are feeling the financial crunch. They provide a vehicle for non-physicians to participate in business ventures with physicians without running afoul of the corporate practice of medicine prohibition. And for physicians who are winding down or retiring, vis-a-vis their ownership of an MSO entity, they can continue to participate in profits after they've stopped providing services. So that's another avenue for an MSO to be useful on the physician side. Next slide. As Dan described very well, MSOs are very attractive opportunities for private equity investors, for owners planning possible future acquisition. They should be concerned not only with operating performance metrics, but regulatory compliance, because that is certainly part of the due diligence that a private equity investor will consider. Next slide. So I hope there's a lot of takeaways from today's presentation, but the final comment I'd leave you with is that a carelessly structured MSO arrangement has the potential to result in a variety of very expensive consequences. We've talked about a number of them here today, and it's a cautionary tale against a carelessly structured arrangement. So with that, I think we can shift to Q&A.
Yeah, so one question is, how can one best structure an MSO if you're seeking investment, either by PE or elsewhere? And I think that's a good question. The thing to understand is that I think using the PE, the private equity model, as a basis for structuring an MSO, even if you have no interest in private equity, is a good idea. And the reason is, private equity is, at its essence, it's a for-profit organizations, private organizations that seek investment capital, usually from institutional investors, who are looking to take a piece of their total portfolio and put it into a potentially high reward but higher risk investment where they can double or triple their investment over a 3 to 5 year period. It's typically what we're seeing. And so private equity is controlled by a lot of very high level financial folks who have spent a lot of time and energy trying to structure things a certain way. So when they go in and they look to buy an MSO or buy practice assets, they want to see certain things. And I think it's probably a good idea to utilize that model, utilize that structure in forming an MSO, even if you have no intention of doing a private equity deal, because it's a proven model. So when private equity looks at MSOs, what they're looking for are a platform that can do the billing and collection, can do the human resources, can provide services to the practice, have a robust compliance program, and essentially enable a scaling up of the size of the practice with little investment. So if a practice has 5 people today, it has an MSO that can grow it to 50 people without a massive investment of capital, other than potentially additional personnel, and has the systems in place that would suffice for a 50-person practice, even though currently there's only a 10-person practice. And one of the hallmarks of an MSO that's been purchased by a private equity is that it has a robust compliance program. I've been through a lot of due diligence with private equity ensuring compliance. They look at every little aspect. If you have any DHS under Stark, they're going to do an analysis of that. They want to look at your coding and billing practices. So, MSOs should probably consider having outside consultants who can help them with coding and billing, and regularly check to make sure that they're engaged in best practices. And there's a reason private equity does that, because they don't want to buy something. They don't want to buy a company that ultimately has liabilities that reduce the value of the business. Looking at your business that way is a very reasonable way to do it. Another question is, I'm considering forming a group practice. Can I use an MSO as a transitional entity? This is a question that comes up pretty frequently when I'm talking with doctors who are looking to form what we'll call a supergroup. And I often will help form that group and form an accompanying MSO. But sometimes, and I've been asked this numerous times, we're having trouble getting doctors to merge into a single tax ID number entity. Can we use an MSO, have a commonly owned MSO, so we can all sort of get used to each other in this honeymoon period, and then use that MSO to help merge us all into a single tax ID number? And the answer is yes. I'm a big fan of the group practice model, and we've done many lectures on that concept and how to put those together. An MSO is I think a very good way for folks to introduce themselves to what it would be like to do business with each other without having to get married right away. And the MSO model is it allows you to consolidate your billing and collection. It allows you to consolidate your credentialing. What you can't easily do through an MSO, and I want to make this clear, is you can't really effectively negotiate managed care contracts through an MSO because of the risk of an antitrust violation, and also for the practical problem that most insurance companies do not recognize MSOs unless you have a single tax ID number practice. An MSO used in that fashion is more of like an IPA, and there are very few successful IPAs that have done more than negotiate one or two contracts. There are some exceptions to that, but generally IPAs are not a very effective way to negotiate managed care contracts in the modern age. But what MSOs can do is they can help practices engage in value-based contracting by helping structure those deals and even negotiate those deals. The antitrust concerns of negotiating a fee-for-service contract are not as serious or not as significant as negotiating a value-based contract, because value-based contracts are pro-competitive, whereas fee-for-service negotiations with competitors are considered to be anti-competitive. So I don't know if there's any other open questions at this point, but if you have any questions and you'd like us to answer them, you can feel free to email us. And Katie has provided, I think, some email information. We will also be happy to share this presentation with anyone who requests it. Otherwise, it will be available at any point. I thank you for your time.